Valens Research, Uniform Financial Analytics.
BlackRock, right, is the largest asset manager in the world, and they are focused on their biggest business now that everybody often talks about, right, is obviously their ETF business. But they also have both equity and credit funds, mutual funds that they manage too, including a very large credit fixed income part of their business. Whenever you come in and you look at a company using uniform accounting on the Valens Research app, you will always start on this screen right here, which is the PVP. And we're very literal people here at Valens. PVP literally stands for performance and valuation prime. Why performance and valuation? Right? Because we look at the performance of these companies in terms of their return on assets and their asset growth. And we look at the valuations of these companies in terms of their valuations relative to their asset base, if you will, a cleaned up price to book, and their valuations relative to earnings, if you will, a cleaned up PE ratio. And then we also have TSR. Why is it prime? Because we're looking at the adjusted metrics. So here, what you can see is for uniform accounting versus the orange as reported bars. The orange are the distorted as reported return on assets for this company. The blue is the uniform accounting true blue return on assets when we clean up the accounting noise. And what you can see for BlackRock as an example, right, it just jumps off the screen. On an as-reported basis, you would think that even though this company owns the ETF world and is a dominant force in that world and in asset management in general because of the move to passive and everything that it's at the center of, right? Return on assets, you'd say, how is this company only a 2% ROA business? This business isn't profiting by dominating this industry. What is the problem? And the problem is, as-reported metrics are misreflecting this company's real performance and its real profitability. When we look at it from a uniform accounting perspective, we can see this company really has 35% return on assets. Just for context, the average company right now in 2019 had roughly a 12% return on assets. This is almost 3 times corporate average profitability. That's how strong BlackRock's returns are. And you would only see that if you're looking at the right uniform accounting data. You'd also only see that the fact that this return has been persistent for the last 10 plus years if you're looking at the right data. But just looking at returns alone isn't enough. We also look at asset growth, right? In terms of how quickly can the company reinvest in its business. It's not just about how profitable is it, how much cash flow does it throw off for every dollar it invests. It's also about how much can it reinvest. And what we can see here is when we look at asset growth for the company, the as reported orange bars consistently misrepresent how much this company is growing. Last year, it looked like they were actually growing when they were shrinking. The year before that, it looked like they shrunk by 30%. In reality, they grew by 12%. Similarly, in 2017, right, if we look at this company, we don't just misunderstand how profitable it is using as-reported metrics. We also misrepresent when it's reinvesting in its business and when it isn't, which should be one of the most simple questions to answer in the world. That helps us understand about profitability. And right, the way that we think about this is if you think of return on assets and asset growth, it's a really smart, simple way to understand what's the free cash flow this company can really throw off in its business. What is its earnings power and how much can it consistently reinvest in that earning power? But then we have to understand not just how has performance been, because right, picking a stock is not just about understanding what the company's done, it's about understanding what the company is going to do versus what the market expects it to do. And that's when valuations come into play. As you can see here, on an as-reported basis, it looks like this company has a 3 times price to book, right? Price to book equity. Now, you look at a company that has a return on assets of 2% and see that, and you say, what on earth is going on? But what we can see in reality is this company trades actually at a higher valuation, roughly 7 times valued asset prime ratio. But if we understand that, if you will, the company's back of the envelope real post-tax cost of capital is around 5%, right? We can understand, okay, so this company is generating a return at 35%. That's roughly 7 times the return that markets require it to generate. All of a sudden, it makes sense that this company is trading at around a 7 times multiple, right? The market is looking at this business and saying, you are a high return, high quality business because it's seeing through the accounting noise and it's paying a premium for your assets relative to that. And the last thing we look at is, right, price to earnings and our uniform accounting price to earnings in this blue bar here. You can see here for BlackRock, as reported versus uniform accounting, PEs aren't actually that far off just for this business alone. But something we want to monitor, right, to understand, is it trading above or below the industry? Is it trading above or below market average valuations? And is it trading above or below what the market has paid for this company specifically? Then the last chart we look at is TSRR. TSR, for those of you who don't know, is total shareholder return. Total shareholder return, quite simply, is just what is the return that you would get from owning the stock in terms of both stock appreciation and any dividend income you'd get from the business. And that R, the second R, TSRR, is relative. Relative to what? Relative to the index that would be relevant for this company. So since this company is listed in the US, the index we use is the S&P 500. And when looking at this, when this line is flat, which actually wasn't any year for BlackRock, but let's say it was flat from 2015 to 2016, that would say the company performed in line with the market. If the market was up 20%, the company was also. If the market was down 10%, it was down 10% also. When it's sloping up, that means the company outperformed the market. When it's sloping down, that means the company underperformed the market. One of the really powerful things that often jumps out when we look at uniform accounting metrics and the market is you can see how clearly the market paid a lot of attention to the uniform accounting metrics here for this business, even when the as reported metrics didn't represent anything at all. As this company saw returns rise and fall and reinvested and didn't reinvest in the business, right, TSR rose and fell. And so we can see that because we see through the accounting noise. All of this is great because it helps us understand what has the company done and what is the market paying for the company. Then the last question is whether or not the market's expectations for the company make sense. And that's when these bars that we haven't talked about yet come into play. These two light blue bars here for uniform accounting return on assets are when we take Wall Street analyst estimates and we push them through the uniform accounting framework, what Wall Street analysts are forecasting return on assets to be for the next 2 years. Right? In 2019, the company did a 35% ROA. Wall Street analysts are expecting it to basically stay at around a 35% ROA the next 2 years. This blue bar is what Wall Street analysts are forecasting asset growth to be if we do the same thing. Then the next question is, what are these white bars? These white bars are at a $107 billion valuation for market cap for BlackRock and a $700 stock price, what the market is expecting BlackRock to do. And right, this is where it becomes really powerful because we can first understand using uniform accounting how good or bad a company's business really is and where it's trending. And then we can understand what the market expects that company to do going forward in a smart way. Right now, using these white bars, we can see at a $107 billion valuation, the market also expects returns to basically be flat, which is what they have been for the last 10 years, give or take. So that makes sense. The market also, though, expects asset growth to be a lot lower than it has been for most of the last 10 years. So that's interesting, right? Market expectations here are for flat returns but low growth. And this is where it becomes powerful because when you talk to the investing greats, all of them will tell you, from Bill Miller to Klarman to anyone else, the first question you always have to ask is not what you think a company is worth or what you think a company can do, but what does the market expect a company to do? What we call embedded expectations. Exactly what this chart is showing right now. It's only after you figure out if you think the market's wrong that you can start to have a conversation about what you expect to happen. So for BlackRock, I think that we can all agree that just considering what the company's done historically, expecting flat returns is pretty reasonable. And we can do some scenario analysis using this embedded expectations tool here to understand. But considering the fact the company has grown between basically 0% and 12% a year for the last 10 years, let's assume that asset growth is going to be a bit higher, right, at 6% a year. We plug in those two metrics and we say, let's solve for what the stock should be worth. What we can see is if we think BlackRock can keep on growing and keep on taking over the asset management world, which is what it has been doing, then all of a sudden, lo and behold, this company isn't worth $700. This company is actually worth a decent chunk more, not 100% more, right? It's not like this company is going to double because of that, right? It's not a $700 business. It's something that's more like a $900 business. Right, it's a 30% upside, as you can see here, in terms of what we're saying the target price for this company would be if this is what the company can do. But here's the thing. We wouldn't even be able to have this conversation. Do we think it can maintain high returns, and do we think it can continue to grow like it has the last 5 to 10 years if we were looking at the as reported metrics? Looking at as reported, we'd say, well, is it going to continue to be a bad business? And is it going to continue to not grow at all like it has for the last 5 years? That'd be the question we're asking. we'd be totally misunderstanding the trends for this business, right? Totally whiffing on even having that conversation to be able to say, yeah, this company might be 30% undervalued. We'd just be scratching our head and saying, what the hell does the market think is so interesting about this company?
Valens Research, the world's leading source for uniform financial analytics.